the other piece behind the oil thing, right, is that we've been living in a world for the last 3 years with no Russia involved, right?
Yeah.
Mm-hmm.
And a lot of the things, no, you guys don't want to talk about politics. I might a little bit.
Hello, and welcome to this week's edition of Freightonomics. I'm Zach Strickland, head of freight market intelligence here at Sonar, and Tony Mulvey, senior analyst.
Yep.
So we've got Dr. Zac Rogers coming on here in a little bit to talk about the latest readings of the Logistics Managers Index. A lot to talk about there. The economy, of course, still very cloudy and lots of moving parts as the new administration really keeps pulling a bunch of levers. And, we're going to try to get beyond some of these headlines and the political factors of it.
I think that's the key is it's so easy because politics are involved to get political, but it's seen, you don't want to get, what's the old saying? You don't want to see the forest through the trees or something. I mean, you don't want to get lost in the political aspects and want to actually get into the meat and potatoes of what's actually happening in the economy. Yeah. I think when you start looking at the freight market and where it stands right now, it's pretty interesting. I mean, I'd rather you kick it off with a market and two to set the stage, and then we can discuss on it further. But I mean, let's set the stage with the market in two. Zach, I'll count you in 3, 2, 1.
Let's kick things off with the Outbound Tender Volume Index. I have not been leading with this index for a while now, and there's a reason. It's because it hasn't been that eventful until this past week. Looking at the white line there, plummeting this week. Now, there is a little bit of seasonality involved, and I think I've got this code cracked. No panic yet. I'm not trying to hit the panic button on the market in terms of demand. You know that I wasn't very bullish on demand this year in general because of all the things going on, but this is a pretty strong downward slide in the month of February. February, downward momentum is always present, especially this time, but rarely is it this strong. I think we've got a little bit of exacerbation going on here due to some of the import structures falling apart a little bit. And speaking of imports, let's go to the next chart. The IOTI, look at this big dip here, this big wavelength that you're looking at in white. That is Lunar New Year. And a lot of that freight would have hit the ports of Long Beach and Los Angeles last week. That takes a while for it to transition into truckload volume. Of course, some of that intermodal volume has also deteriorated. The domestic intermodal has also slid over the last bit. So I think what we're seeing is a little bit of a break apart in the supply chain in terms of timing. February, of course, is a thing. You've got to bleed out some of your inventory levels. It looks like, and we're going to talk to Dr. Z about this here in a minute, that some of those inventories grew probably at a faster clip than some of them wanted to. Let's go to the next chart. Talk about Outbound Tender Rejection Index. It is not responding to the downward pressure on demand, which is fascinating to me. It dropped before the demand drop, and we've kind of been hovering around this 5.5% range for the last week or so. So this is interesting because capacity is not necessarily loosening at the same clip that demand would suggest. And last but not least, let's go to the NTIL and look at spot rates. They are now just moving seasonally downward consistently. A little bit of a hiccup there over the last week, but it looks like everything is going as planned from the spot rate side.
Yeah, I think the only chart in that I don't want to call it alarming, and I think you touched on it. I mean, it's the OTVI one. I think if you were to look at that and you see that big drop in February, you're like, oh, everything's breaking. What's going on? Seeing a decline in February is not abnormal. It's expected, right? Volumes really should start the month higher than they end the month. It's the rate that they've declined, I think, is the alarming part. But I think it's a combination of. I want to hear your thoughts because you said you think you have the code cracked on why, but I think it's a combination of multiple things happening all at the same time that kind of there's a bunch of small cuts to the market that
the most
happening all at the same time that cause
the easiest one to understand is that our freight volume has become so increasingly dependent on import. And to have any kind of buckling in that is probably due to some sort of upstream activity, whether it's in the supply chain. Upstream warehouse, have been moving differently than downstream warehouses. Retail wasn't super great in January versus expectations, but it wasn't enough. But I think we also have this layer of uncertainty.
Yeah.
So we have all these little things kind of adding up to where there's probably just a little bit of a pause as supply chain managers, inventory managers are really trying to figure out what to do next.
And the problem is they don't really have great guidance on what to do next because there's so much uncertainty, again, in the political space that's going to drive economic decisions, which are going to in turn lead to company decisions.
Yeah, and I want to just highlight two stories that I think the audience should be aware of and read on FreightWaves.com. One of them written by Michael Rudolph, Can the U.S. consumer survive a trade war? This has so much information in it, and I'm not going to spend a ton of time breaking that down, but it helps kind of understand what an impact of some of these 25% tariffs would be nominally. There's a lot of good articles cited here. My biggest takeaways are simply that this is a negotiation process.
Yeah.
And if they are implemented, there's still a lot of unknowns, but this is such a complex system globally. We're not going to have a lot of clarity around what the full impacts are. But the United States, of all the countries, if you look through the math, has the lowest amount of impact if everyone acts as they should. Consumers stay in their lanes, et cetera. There's a lot of things there. If corporations don't start increasing prices because they can, not because costs are under it, but there is not as much impact on the United States in terms of inflation as there are on the Canada and Mexico would receive. Currency exchange rates, very important in all of this too. And that's something that I think most of our readers would really like.
Yeah, I think that's probably the hardest element too to understand because it's, if we're being honest, it's completely out of my realm of
Well, we had something like this already in August last year with the carry trade.
Yeah. I think the key is just about everywhere is tied to the US dollar to some degree as a reserve currency or something.
And that's the key to all this.
Yeah. You start, in essence, devaluing the US dollar. That becomes a challenge, right? For everywhere else and not just domestically.
Yeah. For instance, China has been lowering the value of their currency while increasing the value of American currency. So that gives us a lot of purchasing power. Yeah. But it also means that we can't sell things
back to them.
Yeah. So it's all one way, and that's an unbalanced situation, and that's some of the things that this administration is trying to target. So definitely check that article out. The next one, of course, is going to be John Kingston. Quiet diesel market awaits potential tariff impacts on Canadian oil. Definitely dive into this. This gives a good outlook for the rest of the year. There's still a lot of uncertainty here. There's no definitives, but anybody that operates in the upper Midwest, the PAD 2 region, definitely has more of an outweighted influence here than the rest of the country.
Yeah, I think the oil market is one of the more interesting spaces. We've talked about it here. For the last 6 months, that how diesel prices were deflationary for spot rates throughout much of 24 and really even 23. It's not often you get, 20% declines or 20% declines in diesel prices year over year, back-to-back years. Not 20%, but double digits. The uncertainty here is there could be upside, movements where costs go up very quickly, and the challenge is it's a global market, right? The oil market is global. Versus
lots of different interests going into it.
100%. Yeah. You're dealing with OPEC and they act in a way that tries to benefit their members. Yep. And you've got domestic oil production in the U.S. is at an all-time high, but you have to remember it was about 13.5 million barrels per day in production in December, which was the highest level of all time. Well, guess what? The U.S. consumes about 20 million barrels a day of crude oil. So we're still, we may export oil because prices are high, but then we're still bringing in, we have to offset that. So it's like, it's such an interesting market that it's really hard to get a read on anything that's going to happen.
It's normally very volatile, as John
Yeah.
Kingston points out, but it's not been that volatile lately. We've got a little bit of a divergence in direction. This quote right here, I think, says it all. This is from a Bloomberg report, unidentified OPEC delegate. Global oil markets remain too fragile to revive production now. No decision has been made yet, and the group is split on how to proceed. So it's...
They don't know what to do.
They don't know what to do.
I mean, and I think that's a key is like, when you look at OPEC for the past, they've had voluntary production cuts in place for, I mean, almost 2 years, or if not more than 2 years at this point.
Yeah.
And they were supposed to start rolling them off late last year. They've pushed that increasing production now into, I think they were talking about April or May of this year now. So they pushed it 6 months. Like, they're in no hurry to ramp up production.
Why would they?
Yeah.
Well, let's get on to Dr. Rogers and the LMI report for January. I think there's a lot to unpack here. Dr. Z, welcome to the show, man.
Hey guys, it's great to be here. You know, the other piece behind the oil thing, right, is that we've been living in a world for the last 3 years with no Russia involved. Right.
Yeah.
Mm-hmm. And a lot of the things, no, you guys don't want to talk about politics. I might a little bit. One of the things we, have seen in the last week is if we are winding down in Ukraine, who knows, but that's what the talks have been. And Russian oil comes back. And this, Tony, is why OPEC is like, I don't know what to do, because they've been living in a world where, 8 to 10% of all the oil is coming out of Russia. That's been gone. That's allowed prices to stay higher than they should. And now if that comes back at some point in the next 12 months, who knows what happens? It's a tricky time for sure with diesel. And I'll tell you what else is tricky, gentlemen: inventory levels.
Yes,
Our overall report this month went up, and just so everyone remembers, is a diffusion index. Any number above 50 means expansion. The further above 50 it is, the faster the expansion. Below 50 means, there you go. Below 50 means contraction. The further below 50 it is, the faster the contraction. As you can see in this very timely graph you guys just put up, we bumped up 8.5 points in inventory levels from December to January. So we went from 50 in December, which 50 in December is kind of exactly where you want to be. It means we sold a lot of stuff during the holiday season. Downstream retailers in December were a 33, which meant we sold all of our inventories. Now, we did some of that with price discounts, but we sold a lot of inventories. In January, downstream retailers were up to a 56. So we had that 23-point bump. And this gets back to kind of what you guys were saying a minute ago with Chinese New Year. We expect to see January being a time where inventory flows in. That's normal seasonality. Now, I will say that the flow of inventories in January was higher than what we have been seeing for quite a while. I think January was this was the busiest January ever at the port of LA and Long Beach. We're consistently over like 110,000 TEUs, sometimes 120, 130,000 TEUs every week coming in. And that really started in late December too, which you don't see a lot. And it's interesting because if you look now, I think the last week of February, we're projected to bring in something like 70,000 TEUs, which is well below like 30-40% off of where we were at this time a year ago. And so what I do think this tells you is, yes, we had the normal sort of rebuilding inventories post holidays and, around the Lunar New Year and everything, but we brought in a greater level for sure in January and early February. And now you're seeing that kind of come down a little bit. And a lot of that has to do with the 10% tariffs that we put on China. Now, luckily, we avoided the really big tariffs with Mexico and Canada. And I agree with you guys. It would be nice for everyone who puts gas in their cars if we don't do the tariffs with Canada. But we saw this sort of come down from China. Here's the interesting thing, though. So the number that we have is that you guys have in the chart is 58.5. I want to give you a sneak peek of the February numbers because we're pretty far now into our February data. Now this could change a little bit. I anticipate we'll get a fair number more responses. But inventories right now, as we stand in February, and we have a good amount of responses right now, 20 days in, is 69.8. 69.8. So we're at 58.5 in January, 69.8 in February. That would be our highest reading for inventory levels since June of 2022. And June of 2022 was like when we were at the all-time peak of the post-COVID inventory bullwhip. And so what this tells us is people are, just like you were saying a minute ago with the oil, like, okay, how does OPEC work? Retailers, U.S. importers are the exact same place. How do we know how much to bring into the country? Because of all this uncertainty about tariffs, and I think some of it is definitely negotiation stuff. But this is unprecedented levels of inventory for the last 3 years, 69.8, especially when you consider all the way through 2024, 2024 was the year of JIT. I mean, don't call it a comeback. It was real. 52.8 was the average for inventory levels in 2024. 52.8, that's close to 50. That means pretty much stuff goes in right as things come out. Like we're turning over really quickly, which was good in many ways for freight because it meant we had constant activity. Maybe the volumes weren't there, but we had constant activity. Now with the 69.8, that means we've really built inventories up, probably because being a little worried about tariffs. And it will be interesting to see, as hopefully we get more certainty about what trade regulations are going to be, if we see companies going back to that JIT method, which again does sort of catalyze more activity in the freight market, or if we had a bunch of stuff come in and we sort of built it up like a squirrel putting nuts in a tree for winter, and then we'll slowly consume that over time. And if that is the case, then I would expect to see a little bit of a slowdown for freight stuff. And I sure hope that tender rejection rate thing you guys showed at the beginning is just a blip and not a pattern. I don't know that it will fall off a cliff or anything, but the market last year was nice and sort of steady because we had sort of a constant flow of inventory. And it's like traffic. You want traffic to just be, we're going down the highway, we're going 55, everything's easy. It's the start-stop nature. It's not good for your car. It's not good for the freight market either.
My question is going to be, what happens if building inventories this fast? What happens if the consumer doesn't show up? I think that's always, to me, that's an interesting one. You had, disappointing retail sales data to start right. The year. To see a decline in January, it's not really a surprise coming off the holidays, but I think it was underwhelming when you kind of look at things and dig through. I mean, it's kind of, sales are slightly above the rate of inflation, but not significant. I mean, to me, it's like the consumer's finally, I don't say reaching a breaking point, but you're kind of getting what we've expected for quite some time. And I mean, if the consumer doesn't show up and you bring all this inventory in, which is clearly happening, like what is that kind of?
Well, that's what happened in 2022.
Yeah.
So in 2022, we had a lot of inventory that didn't move. And we saw really high storage costs. We saw warehousing prices go up by quite a bit. And looking at our February projections, we see that warehousing capacity so far in February has been negative, meaning like we're running out of space. And that's especially true actually right now for our smaller respondents who have to fight a little harder to get every inch of space. So what you see a lot of times, Tony, when you have these sort of bubbles like this, the people who are maybe in the lower middle class in terms of size, they're the ones who suffer the most because they have the less extra cash to go get more space, or they don't have the first pick of space. And so it can really increase their storage costs, which are then passed on to consumers. And if that passed on to consumers and it sort of, stimulates inflation a little bit, then you have even less spending, which then leads to more inventories. And so you kind of get into this loop, and that's where we were in 2022, which was, about the worst freight market we've ever seen. 2022 into the middle of 2023. So again, I'm hoping that doesn't happen. It is interesting that the Fed has said like, hey, we're not cutting interest rates for a while because we're worried about inflation. And so the combination of a big inventory buildup because of trade concerns and inflation, which may also be somewhat related to trade concerns, that would make it really tough for the freight market, especially considering that we've sort of just come out of the last downturn. You know, if sort of everything in December was looking like we're going up, but now with the trade stuff here, it seems like that growth may be plateauing a bit, and hopefully not going in the wrong direction.
Yeah, I kind of want to stick on the warehousing segment for a second here. We've got the warehousing prices and warehousing capacity figures, and they're doing exactly what you would expect based on what you just talked about. Prices are going up, capacity is going down in January. Is this in any way kind of a, I have had some people reach out and say, and they were smaller, and they were like, what's the warehousing situation like? And you just said it. It's tougher for a smaller firm to go out and secure this storage, this capacity. They don't have the buying power. What is this a blip though? Like, is this like part of the looming trade war kind of uncertainty that's going to resolve itself? Because January, February, this is normal activity, just a little bit more elevated from what I would expect.
Yes.
Is this a blip, or is this kind of like the direction, the start of a longer term trend?
So what you just said, Zach, is exactly right. That's why you're Zach 1. That's what you said is exactly right. This is basically normal behavior, just a little bit more so.
Right.
So this is normal. Normally, yes, we restock in inventories, but we restocked more than normal. Usually warehouses are always start to fill back up in Q1, but they're filling up a little faster than normal, and it's a little bit tighter. I mean, just to give you a number between upstream and downstream, or it's not upstream, downstream, rather, big and small firms, warehousing utilization in January for our smaller firms, this would be firms with less than 1,000 employees, came in at 79.4. That was 22.7 points higher than our larger respondents, anyone with more than 1,000 employees, who came in at 56.7. And so it's really, really tight if you're a smaller firm right now. And part of the reason behind that, I think, actually is also that the smaller firms were more worried about tariffs because they have less free cash flow. And so I think there was a lot of companies out there, especially small retailers, who sort of they did the back of the napkin math and said, okay, well, if things go up 10%, are we better off just buying, 3 months of inventory in January, avoiding that tariff, and we'll eat the storage costs on the back end? And I think that's a lot of what happened. And so if we do see the trade stuff sort of calm down, or at least stabilize, then I would expect us to move slowly back towards more of a JIT model, not as much as we had last year. And one thing I will say is that if we look at our future predictions, overall inventories came in the 60s for January. It was a 63 upstream, 68 downstream. Those are higher than what we've had over the last year, but they're lower than what the predictions were at the end of December, when we really had no idea what was coming. And so I hope that we would see things stabilize, especially in the warehouse market, because one of the things that happened in warehousing is we sort of stopped adding a lot of capacity last year because prices had really, slowed quite a bit, or price growth had slowed a bit, especially compared to 22. But I do think we are seeing, because of that, we don't have a lot of flex capacity in the warehousing market. Warehousing is behaving a little more like transportation right now, where transportation, we usually don't have much capacity going either way. But this freight recovery has been slow because we had so much extra capacity. Warehousing, we don't have a ton of flex capacity right now. And so we dropped down to a 51 in capacity in January. And right now, where the numbers stand in February, it's a 49. That tells us that this wave of inventories that came in has immediately eaten up all of that cushion that we had in warehousing. And as a result of that, we saw warehousing prices pop up to 73 in January, which is the highest number we've had Yeah, as you can see, in quite a while, since probably sometime in mid 2023. I think maybe October 23 is the last time. And so again, it would be good if it was a bubble. If we go back to this JIT, a swift even flow is what we want. But if there continues to be uncertainty around things like the cost of fuel, the cost of steel, the cost of all these imports, then I would anticipate that we keep seeing higher levels of warehouse utilization and price because people are trying to, be careful, basically.
I think it's interesting. I think hearing all of this as a transportation provider would be like, oh no, what were we about to double dip? But I think the difference is if you look at the capacity metrics, like we're back, it's reverted and it's come back down to a fairly normal level. I think that's a positive sign versus where we had all that growth. It's like it may not feel as bad as it did if you have some issues in 22 or like you did in 22. It may not feel as bad.
It's like it's new, but it's the same. At the same time, like we're a little bit different than where we were. Dr. Z, we are, of course, right out of time as usual, running up to the clock. Go to the-LMI.com to read more of this.
We got to get you guys an extension on your time slot.
I know, right? Have a great week.